Hello to another review. Today we will be reviewing the trades I placed at January 8th. This day we had several high impact news including ADP non-farm employment change, unemployment claims, and also FOMC meeting minutes in the afternoon. I didn't trade the afternoon, I only traded the morning. And you will see in this review that I actually placed two trades. They were both losing trades. And I will also go into, alright, what have I changed to my strategy to avoid these losing trades in the future? And I will explain how I did that as well. So sit tight, let's go over this review step by step, and you will see my thought process and how I eventually improved my system based on these losing trades yesterday. So if we start the day off, we will see that we have a discounted opening range gap of 33.5 handles, and that we also have our NDOC bias, our NWOC bias. Those both are bullish, and our daily liquidity bias is also bullish, meaning that our finalized bias is bullish, as you can see in the bottom here, and everything combined is just screaming bullishness. Um, So when the first presentation came, the first thing that I immediately did was very simple. We had a first presentation fair value gap in discount. So with all these things that are screaming bullishness, I just placed my long trade. This is my first trade with 8 contracts, and you will see that we get stopped out very quickly. So during this trade, what I noticed is that we have a lot of liquidity here, over here, and it actually didn't really satisfy me knowing that there still was liquidity here, but because we had equal highs over here and that my target of 25% was over here, and why is my target over here? Well, my minimum handle run on M&Q is 40 handles, so that's why it's over here instead of the 25% over here. Anyway, I knew that this was probably going to be a higher risky trade, and I didn't know yet how I could have predicted that I should not trade this day, but I will go over that later on after we have placed our second trade. So the first trade, it was a loss, and that's okay. There's no problem with that at all because we can trade twice. So let's see. Alright, so we close above the first presentation again, meaning that we can place another trade, and we are creating even more equal highs to the upside here. But notice that we also have these relatively equal lows as well. So price is still able to go both sides. But with this wick rejection, when I saw this live, I was like, okay, this probably will first clear the upper part and potentially will go down after. That's okay. I don't mind because then my strategy would have been satisfied. But what actually happened was this huge ass candle. Like, I don't know what happened here exactly. I know that right now we were in macro time, but we first ramped down to the downside, and what happened after was quite interesting. We first ran down to the downside, and then we actually went to my target, which was very annoying. So I was still confident because the strategy still worked, kind of, but because we had so much liquidity here as well, there was more of a risk-on situation. But it is what it is. I followed my strategy, and we took some losses. For your information, I lost $1,025, I think, on this. I placed a broker statement on my X to be extremely transparent with you guys. Like, I don't want to lie, like I only place my winners or something like that. That wouldn't be honest. So this was the entire trade, and I had 2 losses. Afterwards, I went into reflecting mode, and I was like, how do I solve this? And one thing in my algorithm is that this gray box over here and this middle line, this consequent encroachment line of that box, it is something in my algorithm that I didn't show before. But this gray box, this middle line, is actually the magnet of the average pricing of the NDOCs and NWOCs, in which I also calculate the clustering of NDOCs and NWOCs, meaning that that gray box is a very huge part into my draw on liquidity. Meaning that if the price is below the consequent encroachment of this box, we are in discount, and if we are above, we are in premium. And if you also combine that with setting profit targets, then it means that if you want a profit target that's above the consequent encroachment of the draw on liquidity, in this case, meaning that if we go above here, then we will want to go to have shorts instead of longs, that the likeliness of having trades around this area is very difficult. So that's made me think, and I programmed a little thing in here. And what it is that if we are setting our profit targets when we are in discount and we are looking for bullish price action and our profit targets are to the upside, and that's above this box, then I will not be allowed to trade. So in that reasoning, I'm able to, in the future, save money in these kinds of situations on non-farm payroll weeks. So I hope that I explained that clearly enough. It's a little bit difficult to go over the complete math. Um, so if you've got any questions in regards to it, feel free to ask, I would say. But for your idea, what the change is, so before right now I have it enabled, that button. But if we disable it, you will see that from the 16th of December, so the MNQH contract, before this change, this was my P&L. So right now I would be in minus $136, but with, and this is actually what my P&L is of since the 16th of December because of this trade here. If I enable it, then you will see that everything goes up again and then everything becomes a little bit more smooth. So I will keep this option on from now on and see how everything will, well, how it will work in the future. I also did try it on the cash register as well, and it gave a little bit of higher P&L. So I'm very satisfied with it. And I hope that you learned something from this video. It is potentially a little bit complicated, but the essentials from this video are: if you have a loss, review what you could have done better and why you potentially would have lost. So yes, I know that this week is not from payroll week, but I also know that, all right, it was very close to a potential turning point in price, because once it actually had hit my profit objectives, it immediately went to the downside. Like, look at this. So this is that line of where I said that's the consequent encroachment of the N dogs and N walks. It hit it, and look what it did. It went down straight, like there was no tomorrow. And also combine that with having a Reaper fair value gap over here. That's the orange one. I knew that there were complicated things coming up here. So I saw what the issue was. I reflected on it. I found a solution, and sure, we lost $1,000, but we learned from it. Thank you for watching. Leave a like, leave a comment, and if you want to keep following me, subscribe, obviously. So, bye bye.
Hello, hello, hello. Welcome back to another review of the ICT 2024 mentorship trades that I have taken so far.
This will be a review of January the 13th, where I made 15% on, to be precisely 14.5% on my portfolio. So we went from an account size of 15k to 17k. You will be seeing the live executions afterwards. So if you don't believe me, you will have your proof. And yeah, let's just go over it on how did I take this trade or trades. And yeah, just review the day. So we know that this week actually we had PPI, CPI, and Monday was a non-trading day. So originally you might think that Monday would be a consolidation day so that it can be manipulated by PPI and CPI later on. But it actually gave us a lot of clean price action for some reason, and that gave us a great opportunity to trade. So let's see what we're working with on 9:30. So, well, not 9:30. Well, let's see what we're working with after first presentation is formed. So to start off, we have a discounted opening range gap of 253 handles. So we already have a gap size that's extremely large, meaning that for my strategy, I will actually be dividing the opening range gap to its midpoint and actually start taking profits on the quadrants of the lower half of the gap size of the opening range gap. Next to that, for this particular trade, I was only looking at the NDOC and NWOC bias with a daily liquidity bias. So I didn't look at the weekly, the pre-market, London. I was only looking at the NWOC and the daily bias, in which the NDOC and the NWOC bias gave us a bullish bias, meaning that the clustering of NDOCs and NWOCs was to the upside. So the draw on liquidity was to the upside, and the same counts for the daily liquidity bias. And you could have a look at that here actually. So we didn't have any daily liquidity left. These red lines are the daily liquidity, and we have one liquidity pool here with equal highs actually to the upside left. Meaning, where does price want to draw to? That price, right? Combine it with the clustering of gaps. That's our bias. It's easy as that. You don't have to complicate it. But all right. So we have first presentation formed. Interesting to see right here is that why is this gap drawn from that wick to that body? Well, if we zoom in and put our fibs on this, is that there's a small volume imbalance over here. And when there is a volume imbalance, you have to do a measurement to see if the wick of this candle surpasses 50%. If this wick would have surpassed 50%, like it would have been over here, so that the wick would have been like here, then you would have been drawing it like this. But when a wick surpasses consequent encroachment of a gap, you will not draw it. If it doesn't surpass it, it will stay in the bottom half or in the upper half. If it is this wick, then you will be drawing it entirely and incorporating it. All right, so first presentation formed. We are in a discounted price compared to the opening range gap. So that means that we are in heavy discount currently. We have a bullish bias, which means this is an amazing trading opportunity to try and see what the market can give us. So let's go. What we're currently waiting for is that price closes above the first presentation so that we can have a nice entry. We see that price gets extremely volatile here. So what do? We place an entry at the one tick above the first presentation and one tick below this candle over here. Let me, by the way, adjust that a little bit because that was not my actual stop loss. So wait, was it? Oh wait, never mind. It was. Excusez-moi. So, all right. Normally, when you place your stop loss below the fair value gap, you will use this candle's low. But because we have the volume balance included, we actually see this entire candle, these two candles as one candle, meaning that our stop loss will be put one tick below here. Hopefully that makes sense. I still have to wake up a little bit, so hence why I had to look twice. All right, so we place our entry and we get triggered in a few minutes after. Um, so our TPs of 25, 50%, 75, 100%, and 125 take profits are placed. We go to break even at 25%. Once again, I'm going to repeat myself. Why is my 25% actually at the 12.5%? We have an enormous gap. So when that happens, price tends to stay actually in the lower half. ICT actually recently released a video in regards to trading the opening range gap in his 2025 lectures. Here he mentions this as well. And yeah, when you see that there's a larger gap, we tend to actually stay in that lower quarter size, and we would have to see if we actually want to go up, yes or no. And my adaptation to that is that I just divide the gap in two and use the lower portion as the original quadrants, basically. All right, so we are in a trade. We actually get to take profit relatively quickly, like it was only 7 minutes before we could go to break even. 9 minutes before we have 50%. And afterwards we didn't quite reach for 75% and actually get taken out after. So, but we got stopped out at break-even stop loss. But the day doesn't end here actually, because there was still a lot of liquidity. What is this doing? Okay, there was actually still a lot of liquidity to the upside here. And you will see that we eventually create a little bit more liquidity here as well. So shortly after, what happens? So we got taken out, we go down, we go up. We have placed a limit order right now over here, and we see that price goes up, eventually takes out that 75% that we were originally targeting. And I have to be honest with you, I was a little bit annoyed over here, because we got taken out and price then goes to my profit objective, and I'm like, oh, why do you do this? But then I noticed the following. We didn't quite reach the consequent encroachment, the midpoint of the opening range gap. And we did like create a little bit more equal highs over here with this new high. So I was like, interesting. Our bias is still bullish. Nothing changed in that regard. So we will just keep our limit order over here. And you will see that around 12, we got actually tagged in. Not yet, not yet, not yet. We're creating a lot of liquidity. So something to notice here is that we actually created a small liquidity pool over here. And we take that liquidity pool out and we get tagged in at 11:58. So this is actually the lunch macro. And within the lunch macro, what most of the time happens is that we will take out a high or low that is formed after 10. So what is this? This is a swing low formed after 10. This is a swing high formed after 10. And, well, what does that mean? Swing low, swing high, one low is taken out, and we are currently in a trade. By the way, check how nicely this is respected. We didn't close below the first presentation. We remained in this part, which is very nice, and we had an extremely large, huge reaction from this actually. So we hit 25% extremely quickly again. I think a little bit longer than 7 minutes, like the first one. So 12 minutes, and we can go to break even. And shortly after, we hit 50%, 75%, and we are creating relatively equal highs right now. This is just a small pullback. It's all okay. And we take out those relatively equal highs. Full gap profit. and from here on, it's just price kept stagnating a little bit. Um, so we eventually get to our 125. So all our contracts are sold. We still have one contract left. We have a runner left. Um, and actually at this point, I started to have I was like fully out of my position, and I only had the runner left. So and our price was at break even. So I just went for a nice walk with my girlfriend, and I let that runner run. And what happened? Well, price just kept moving up towards this new week opening gap that was of this week. This is this week's new week opening gap. And I closed my position at 1630. So now you might say, but MW, Jelle, this is your indicator, your strategy. Did you actually execute on it? Well, yes, I did. So as you can see, I'm logged in on AMP Live. Let's enable the executions and actually go out of the replay mode because otherwise you don't see it. And as you can see, here's that first buy of 7 contracts. We sold 2, we sold 1, and then we get stopped out, right? Same here, buy 7 contracts. I actually mispressed. I was managing this trade on my phone. And what happened here? Why did I sell 2 contracts here? I actually mispressed the sell button. That's normally over here. Um, because I was trying to change the contract size from 1 to 2. So yeah, because I was trying to set limit orders on my mobile and I mispressed, so that happened. So that's why I sold 2 here accidentally, then bought 2 back pretty much instantly, as you can see. Actually, in a little bit more of a discount. And then we have our basic 25%, 50%, 75%, full gap closure, in this case midpoint of the original opening range gap, 125%, and then the end of day at 430. I was actually thinking about holding this overnight, but because my strategy is to close my trades at 430, this was the decision I made. If I had held it, well, it would have been a very nice trade, as you can see. But it is what it is. So this trade, I actually made 2270, so 2,217 US dollars, and the account size was 15k. So I made 14.5% on this day, and yeah, that was all she wrote. So if you've got any questions in regard to this review and how I actually looked at the price action, feel free to ask, and I will try to answer your question as good as I can to the best of my abilities in comments. So thank you for watching, and until next time. Hello, 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 and welcome back to the review of the trade I took on January the 16th. As you can see, this is the outlook of how the whole trade was. What you can expect today is me taking slash explaining 2 trades that I've taken yesterday and how I've taken them, and how actually the confluences of the bias that I gave earlier that day, because if you didn't know yet, I actually give my daily bias every day between 8:30 and 9:30 New York time on NQ and MNQ, and I will show you how that bias actually played out. And that's actually also where I wanted to start with. And what I wanted to start with was that in that short of the daily bias, I told you to pay attention to 21,220 and 21,180. That is this gray box over here. Keep these price levels in mind while we are going to do our review, and you will see something very interesting happen by the end of it. So I promise you, you will really like this. All right, so let's have a look on 9:30 when we actually opened. So we had a gap of 120 handles, 120 and a half to be precisely. If you have watched ICT's latest 2025 lectures, he mentions that when the gap is above 120 handles, that you should be looking at only trading to the 25%. Well, I myself do not precisely use this metric. I do take it in consideration, like when gaps are bigger than 120, I actually tend to look at the upper half instead of the whole or opening range gap itself. So let's see what happens when first presentation is formed. So at the 9:33 candle, first presentation is formed, and we see that also a limit entry has been placed. To take into consideration is that you see a small volume imbalance over here, meaning that instead of placing my stop on this candle's high, due to the fact that it is a volume imbalance, I will place my stop loss on the candle's high of the volume imbalance itself, and that the entire fair value gap, the first presentation fair value gap, is this wick to the opening of that candle instead of this high of this wick to this low of this wick. So with 16,500 in our current account, we are able to put 7 contracts on, and we place a limit order. We get tagged in immediately, well, immediately 2 minutes in, and you will see that we have a good reaction from it actually. Like, yes, the wicks stay inside, but we close below all the time. I have my first take profit of 6 contracts over here. Why is that? Because, well, currently you see that we cannot really take profits at 12.5%, 25, 38.5, or 50 because we already, well, we are very close to that. So that means that the earliest target that I can hit is a minimum handle range that I actually target, and that is 40 handles minimum. So, alright, let's see what happens. As you can see, after that this fair value gap is created, we don't go to our target immediately. I have to admit that I actually got a little bit anxious when I saw this, that we closed above. But you will see that we actually respected consequent encroachment of this wick. So the wick that is very large here, and that's actually also the wick of our fair value gap, is being respected. We remain in that lower quadrant, and after that happens, you will see that we actually go to our target, like with some very heavy downside movement. From this moment on, I actually just had a runner on. So because I closed 6 contracts, I set my stop to break even, as you can see. And we will just barcode a little bit. It's very interesting to notice that orange gap. This orange fair value gap is actually a Reaper fair value gap. And not just any Reaper, no, it's the first fair value gap presented of the new year. This is the, well, not new year, this is the one of the 31st of December, if I'm correct, or the 30th of December. You will see that we will just, price will move around a little bit here and doesn't do a lot. Eventually, we get stopped out here at break even at 11 o'clock, and we actually move above the first presentation fair value gap. And what do? We take out the liquidity over here. And what is this liquidity? Well, we have several points of liquidity. If you have followed the 2024 mentorship, you will know that ICT speaks of a lunch macro being activated at 11:30. In this case, the macro already started a little bit, and it took out these highs that were created after 10, and this high where a lot of people potentially would have moved their stop loss towards. And what liquidity are we left with? We are left with these equal lows over here. So you can also see that my algorithm, once we closed below the first presentation again, we placed the limit order again with 6 contracts here to go to break even and then continue. So as you can see, we get tagged in over here. We do had to endure just this little bit of drawdown, but it was okay. Again, it respected the wick of that first presentation candle, and immediately you see how heavy it moved down again. So we had 6 contracts profits very easily. We only were in the trade for, as you can see, 11 minutes till target. Here we were in the trade for also 11 minutes to target. So we put our stop to break even. Nearly get taken out over there. But we see that price just continues to keep moving. A little bit sideways. But then around the the PM session, you will see that we actually start dropping. And it's very interesting to see that we actually move above and below these new day opening gaps and this reaper fair value gap. And from that moment on, we just continue moving down and below these price ranges. And eventually we drop down all the way till the end of day. So as you know, I close all my limit orders by 5:30, by 4:30. And one thing is very interesting to see. So remember this box that I mentioned? So the 21,220, 21,180. I close my orders here. But look what happens after. We just keep moving up after. So this is a part of which I actually arrive my bias from, and it has to do with the new day opening gaps and new week opening gaps, and where my draw on liquidity is. So my runner actually got stopped in my draw of liquidity, which was this box. That's why I mentioned it on the short. And I thought that it would be a very useful little thing if you listen to my shorts carefully with my daily bias. So it was a very nice day. We made, I think it was 1,600. So it was a very good day for me. It was around 10%, a little bit less, I think, or exactly 10%. So yeah, what can you actually derive from this? Well, you can derive from it that the first presentation, when utilized correctly, is a very strong entry model that is being taught in the 2024 mentorship. Next to that, the new week opening gaps and new day opening gaps are actually what are driving the bias of the market. And what you also can derive from this is that you should actually watch my daily bias that I put out every day at 8:30, between 8:30 and 9:30 New York session time. Because sometimes I do not trade on a day, and I mentioned that in my daily biases. But I also, if I do not trade, I still say, okay, I favor this momentum to the downside or upside. And most of the times it has been correct so far. So if you enjoyed this, give this video a like, subscribe if you want to keep want to be kept up to date, and I talk to you guys next time. So bye bye. Hello, hello, hello. Welcome back to another review today on a trade that we took on January the 20th on Trump's inauguration. And it was actually a very nice trading day for me. It was not a very big win, but it was a decent win. Like today, we actually ended the day on $660, and we also finished 250k top step accounts. So let's have a look on how we did that, and then you might learn something as well from it. So first of all, when we are going to look and scroll forward to first presentation being generated, so there we go, we see that we have a gap size of 139.5. So if you have been watching the 2024 mentorship and the 2025 lectures of trading the opening range gap, ICT mentions that whenever we have a gap size that's bigger than 120 handles, you should expect the price not to go lower than 25%. And I adjusted that a little bit according to my own model, where I will trade instead of the whole quadrants, I will halve the entire opening range gap and will trade the quadrants of that. So that is what we are currently looking at. Also next to that we have a new dog, NDOG and NWOG bias. Those are both bearish, and we have a daily bias as bearish as well. Right now we are looking at MNQ, but the NQ one that I trade on my funded accounts is actually also incorporating the weekly buys, and that was bearish as well. So let's have a look. So first presentation has been generated. We are looking at a premium gap. Everything is screaming bearish, meaning that every part of our strategy is currently not conflicting with each other, meaning that we have a very good likelihood of having a nice trade today. So let's see what happens. As you can see, right now prices was still playing a little bit with us. It was not closing below, and eventually we did close below. As you can see, we actually already closed below on this candle, but this candle didn't close low enough. So in my strategy, I right now have that the candle should close X amount of handles below before I consider it a valid entry. But it does close below enough on this candle. And as you can see, we immediately get triggered in as well. Right now, this is set on 8. Yes, 8 contracts. Do not have a look at that. I traded myself with 7 contracts instead of 8, so that you are aware of that. So anyway, we go in, we put our stop loss on the high of this candle, well actually one tick above it, and we put our first target, as you can see on the next candle, on the 12.5%, but not entirely the 12.5%. Why? Because I added something to my strategy recently, and that is that my first TP has a minimum amount, but also a maximum amount. And in this case, it was that the maximum amount of 12.5%. This was larger than my maximum amount handles, so we place our first break even here instead of here. And after that is just the same. We take profit at the 25% of 38.5, the midpoint, and then well, the next one, the 125%. So relatively quickly we actually go to our profit objective. I have to admit that during this time that we got back into first presentation, I got a bit anxious, especially because our stop was not that large. It was, I think, it was 8 handles. Here you can see 7 handles, but it was around 7 to 8 handles anyway. But every time that we just wicked in it and didn't close above consequent encroachment, that gave me some more conviction that it was all going to be okay, and that we will go eventually lower to at least our break-even target. So we hit our profit target, our first 25%, we take off 2 contracts, put our stop to break even. We quickly hit 50%, we even hit 75% if I'm correct, and even 100%. So according to my philosophy of when the gap is greater than 120, we just reached full gap closure. It is not a full gap closure, this is just midpoint, but this is according to my philosophy of instead of halving the quadrants. So what you will see is that from this moment on we will just keep going up. We will go one slower, as you can see over here. You will see in the end when I will show my AMP live trades, I didn't do it on purpose, but I forgot to place a limit order over here. So I actually have a limit order over here. I was having dinner with my girlfriend at this moment being. At least I was cooking dinner, I think it was, but okay. And as you can see, eventually at 1 o'clock, we stopped trading. And I actually did hold 1 contract overnight. And we actually got stopped out soon after. As you can see, we get stopped out. But I did hold one contract overnight because I was like, these seem like relatively equal lows. Let's see how it will go after the opening. And as you can see, quickly after that we got taken out, we went to those equal lows, as you can see. So it was set up, we got taken out, because otherwise we would have had a very nice trade of, let's see, well, 200 handles plus. But again, this was still a very good trade. I'm very happy with it, and I will show you my live executions right now. So let's go to live executions, remove those. And as you can see, these were my live executions. On X, I also showed these as well, but I had first presentation marked out, which is over here. And if you just remove everything from the chart and just hold first presentation, you see that this is a very clean trade, and how powerful first presentation is even over here. Um, and as proof of the finishing two 150k top step accounts, this was one account, and this one is 171k actually, because I had to gain 11k more, because once I actually forgot to set my limit orders, and due to that fact I had to earn 11k more, like I said, due to the consistency rule. The other one did have a nice 159k, um, the normal profit target, and I am now funded with 300k extra on Top Step. So if you've got any questions in regards to the trade that I placed yesterday, well, feel free to leave a comment. And if you are interested in having a trial on the NW Liquidity Scalper, which I share a lot of on Twitter, well, you can actually go to my Twitter and sign up for a free trial over there. So for now, have a nice day, and be safe. Hello, hello, hello. Welcome back to another video. Today we'll be having a case study and live execution example of the MW Futures liquidity scalping algorithm. I give access to this script every month to 5 people, so if you want to also make use of this script, make sure to follow me on X, and around the 20th of every month I will set out a message so that you can apply to get a trial license of this particular script. So just keep an look out for that, and yeah, let's go into the review right now. So this is a case study of January the 27th on Monday, and this is a day where big tech dropped overnight a lot due to the DeepSeek release, and it gave us a very large opening range gap of around 6 to 700 handles. But it is very nice to see that once we go to the opening candle of 933, or at least at 9:30 the opening candle is there, of course, you will see that our default settings saying that the weekly, daily, custom and midnight opening price are all bullish. We are currently in our trading period sessions. We are currently trading, so we should pay attention for signals that are being provided by the algorithm. And let's see once the first signal is placed and how it is actually sent. So around 9:59, the first signal, the first alert has been sent to take a limit order of 6 contracts to the upside. And let's have a little breakdown of what's actually happening. So right now we have 1, 2, 3, 4, 5 liquidity pools to the downside, and we have 1, 2, 3, 4, 5, 6 liquidity pools to the upside. So that means that we have more buy side liquidity than sell side liquidity. Incorporate that with the bullish bias and a finalized bias that's bullish, meaning that we are allowed to trade today. So we get the signal, we place our limit order at 21,238.25, and it takes some time before we get tagged in, but then eventually at the 10:19 mark we are tagged in. We have a little bit of drawdown of, let's see, around 9.5 handles. Within, let's see, that is in 4 minutes we have hit our first TP, and in the next candle you will see that we have put our stop to break even, and price basically just continues to rise. New liquidity pools created around 10:32. We just keep taking profits. So right now, of the 6 contracts that were in, we have already taken off 3. Now we have taken off 4, and from here on, price will actually go back, and eventually we will hit our stop loss. So this is a very good example, very good case study of how many liquidity pools are there to the upside, how many liquidity pools are there to the downside. A practical silver bullet entry trade according to ICT, and everything was set in stone for you to take. So way in advance, we knew where to place our limit order, where to place our stop loss, where to take our first profit, when to go to break even, when to take separate take profits that was generated during the actual trade itself as well. So this is a great example of how you can use the script itself. And once we go back to the real chart and disable the algorithm, you will see that instead of 6 contracts, I entered with 7 due to I tried to add a runner contract potentially. I bought 7 here, sold 1 there, there, and then we got stopped out at break even. So this was a $900 day for me. And this is also just to prove a point in regards to I put money uh, behind my words. Like to show you guys I'm not just all words. I actually trade the algorithm as well once there is a setup. So proof of concept. You got your entries. Everything was bullish. It showed you what to look for and where to enter and exit your trades. So hopefully you liked this case study and hopefully you made some money with it as well. I myself made 950 bucks with this. If you had traded the Nasdaq, then I think it would have been, if I'm correct, 10,000 something. Yeah, if you would have traded the Nasdaq, you would have had 10,500. But due to the fact that I did this with my live broker, AMP Global, AMP Live, as you can see, I didn't have the margin to trade that. So yeah, that's that. I hope you enjoyed it. If you have got any questions, feel free to leave them in the comments. Hit the subscribe button if you want to be kept up to date in regards to the daily biases that I give daily. And yeah, talk to you guys next time. So bye bye. Hello, 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 and welcome back to another case study on the MW Futures Liquidity Scalping Strategy. So this is a case study of Wednesday the 29th. This was yesterday, and a trade occurred around the 10 to 11 silver bullet hour. And let's look at the overall market today. So as you can see, a lot of liquidity has been taken out to the downside. We have been taking out liquidity to the downside all the time, and there hasn't been a valid fair value gap yet to enter off from our default settings. So let's move on a few minutes further, a few candles, and wait till the current custom bias. As you can see, the custom bias is right now still bearish. We have a finalized conflicting bias, meaning that we cannot trade yet. So we are waiting for all these biases to align. So let's wait for the bias to turn bullish, which is on this particular candle here. As you can see, we place a limit order of 10 contracts and we get tagged in. New liquidity pools have been generated. So instead of taking profit here, we place one TP here and there. As you can see also is that instead of 2 contracts here, it is split up into 1 and 1. And of course we have a lot of take profits over here as well. And this case study is mostly done right now around a new feature that just has been introduced, and that is the new mechanic of how going to break even is being handled upon market close hours. So as you see, our trading times right now are between 7 and 11:30. In before at 11:30, what happened was that we would go to break even. But once you are in drawdown, you actually close your orders out because the price is here and your limit order is, well, your stop loss is over there. So that means that you immediately get cancelled out, right? So let's go to the 130 candle and see what happens to my trade while it is in drawdown. So right now it's 130. As you can see, we are in drawdown. We have been moving above and under our entry all the time. And what does the next candle say? So first, new liquidity pools have been drawn again. And on that next candle, so that 1131 candle, what we see is instead of that our break even price, our stop loss has been moved to break even. Right now what we do is that we actually drag all our take profit targets and put it at our break even price. So that is basically what has changed now, is that once the market closes and we are in drawdown, we want to exit as soon as possible. So we put our stops to break even costs, meaning that we cover commissions and all the fees. And you will see that we hit our TP, and after that we would have been stopped out otherwise. So this new feature, I already backtested it a lot, and it actually, a difference was that it actually saved me $2,000 over the backtests of the last 2 years. I mean, $2,000 over 2 years, it's maybe not be a lot, but once you add that up with when you're going to trade higher contracts, etc. For example, these are micros. $2,000 on the minis would have been $20,000, you know? So it adds up. So that was the trade review of Wednesday the 29th. I hope you enjoyed it. If you've got any questions, feel free to leave them in the comments. And I'll talk to you guys next time. Bye bye!
In the morning light, markets take their flight. Nasdaq opens tight, always